A critical Bitcoin metric quietly hit an 8-year record last week. It might reveal the next big move in crypto, and when I dug into why, I found something that could change how we think about the next few months. Picture this. It's late at night, I'm staring at a chart of Bitcoin exchange balances, and the line is plunging down to a level we haven't seen since 2017. I did a double take. 2017, that's 8 years ago, back when Bitcoin was rocketing towards $20,000 for the first time, and I was still getting my feet wet in crypto. So naturally, I'm asking myself, why on earth are so many Bitcoins suddenly vanishing from exchanges? Is this bullish, bearish, or what? I had to find out. Now, if you're wondering why it even matters whether Bitcoin is on exchanges or not, think of exchanges like store shelves at a supermarket. When Bitcoin is on an exchange, it's sitting on the shelf available to buy or sell. When someone pulls Bitcoin off an exchange, it's like they took it off the shelf and put it in their own pantry at home, meaning it's not for sale anytime soon. So when we see tons of Bitcoin leaving exchanges, that usually means owners are locking it away in personal storage. It tightens the available supply that can be traded. And according to the data I'm looking at, the total Bitcoin on exchanges worldwide has fallen to roughly 1.8 million BTC. That's the lowest amount since mid 2017. Wild, right? To put that in perspective, Bitcoin today is hovering around $93,000 per coin. In 2017, it was closer to $10,000 to $20,000 during that year. So here we are at roughly 5 times the price we were in 2017, yet the exchange supply is at the same level as back then. It suggests that a lot of Bitcoin has been steadily moving into long-term storage despite the high prices. This didn't happen overnight. The trend has been building for a while, especially after some high profile exchange blowups taught everyone a lesson. More on that in a second. But hitting an 8-year low is a milestone that really caught my attention. So I dove into more data to understand what's fueling this. One interesting metric is something called the realized cap of Bitcoin. Without getting too technical, realized cap is like the aggregate cost basis of all Bitcoins in the network. When it goes up, it implies new money has been flowing into Bitcoin, coins moving at higher prices. Over the past month, this realized cap has actually been climbing, which tells me fresh capital is entering the market, even if the spot price hasn't moved drastically. In plain English, people are buying, even if quietly. An analyst I follow named Timothy Mizir over at BRN Research basically said that Bitcoin's underlying structure looks solid and has been steadily improving, despite the price kind of moving sideways lately. He pointed out that accumulation is persistent and exchange supplies are thinning, while price has been relatively stable above something he calls the true market mean. Think of that like a fair value benchmark. In his view, the only thing missing now is a clean break into a higher range. Specifically, he mentioned the $96,000 to $106,000 zone. In other words, all the pieces are in place under the surface, and once we punch through that upper resistance band, it could really ignite the next big rally. Now, $96,000 might sound like a random number, but it's basically the upper end of the range Bitcoin's been stuck under. A breakout above that would be a strong technical signal that momentum is back in a big way. Until that happens, though, we're kind of in this suspenseful waiting period, but a very interesting one because all these on-chain signals and investor behaviors are hinting that something's brewing beneath the surface. And it's not just Bitcoin showing signs of quiet strength. Ethereum has been making moves too. Over the last couple of days, Ethereum actually outperformed Bitcoin. ETH pushed past $3,200. And guess what? Certain big holders were all over it. I'm talking about shark wallets, those holding 1,000 to 10,000 ETH, starting to aggressively accumulate again. Historically, whenever these mid-tier whales ramp up their ETH holdings, Ethereum tends to have a strong run afterward. It's like clockwork in previous cycles. And right around the same time, Ethereum's network growth exploded after the recent Fusaka upgrade, which went live on December 3rd, 2025. The Ethereum network saw nearly 190,000 new addresses created in a single day. That's a huge spike in new users, or at least new accounts, indicating a surge of fresh activity on Ethereum. So between the sharks stacking ETH and new folks coming into the network, Ethereum's fundamentals are looking pretty bullish as well. Now, I'm not trying to derail into an Ethereum video. The main story here is Bitcoin's exchange supply, but it's important to see the broader context. Crypto markets are interconnected. When I see both Bitcoin and Ethereum, the two giants, showing signs of accumulation and growth, it makes me more confident that what we're seeing with Bitcoin is part of a larger trend, not just a one-off anomaly. Even beyond the big two, other parts of the market are stable or growing. Solana and BNB, for instance, have been pretty steady recently, holding on to their gains, and the overall crypto market cap is around $3.2 trillion as we speak. That's almost back to the peak we last saw in late 2021. The difference this time is the vibe. It feels like a stealth climb. Back in 2021, everyone and their mother was talking about crypto hitting highs. Now we've crept up near those levels again, but it hasn't permeated the mainstream chatter in the same way. Maybe it's because we've been through hell and back to get here, with the crashes and scandals along the way, so people are a bit more cautious or battle hardened. But to me, a quiet climb can be a precursor to a louder finale. All right, let's talk about one more puzzle piece: the institutional and macro situation, because those big players and the economic backdrop are crucial. On the institutional side, something notable happened. The new spot Bitcoin ETFs in the US, the ones everyone was hyped about when BlackRock and others filed for them, have started trading and gathering assets. Over the first week, they mostly saw inflows, money coming in. Just a few days ago, they had a tiny outflow, around $15 million net out across all Bitcoin ETFs, which ended a 5-day streak of inflows. That could be just normal fluctuations. Interestingly, BlackRock's ETF, which is by far the biggest fish in that pond, actually added about $42 million that day, so not everyone was selling by any means. And on the Ethereum side, the spot Ether ETFs saw a much bigger move, about $140 million in net inflows on the same day. That shows a lot of investors are still eager to get exposure to ETH through these regulated products. The takeaway from ETFs is that institutional interest is still there. It's not fading just because prices have plateaued for a bit. If anything, the big players seem to be positioning for a longer term play. Now, earlier this week, we had some fireworks in the market. If you were watching on Monday, you know exactly what I'm talking about. Bitcoin had a sharp drop and a bounce, basically a roller coaster in a short span, and it wiped out a lot of leveraged trades. We saw something like multi-billion dollars in liquidations when that happened. It was a bit of a panic moment, I'm not going to lie, but what followed is interesting. Things calmed down pretty quickly. In the past 24 hours, total liquidations have been around $312 million, which is peanuts compared to the carnage earlier. And of those, about $202 million were shorts getting liquidated and $110 million were longs. So what does that tell us? It suggests the price rebounded and squeezed some of those late to the party short sellers. The market basically flushed out the excess leverage from both sides. These cleansing events, as painful as they are for anyone caught on the wrong side, often pave the way for a more stable climb upward because they reset overly bullish or bearish sentiment. Now let's zoom out and consider the big economic picture. The macro environment is shifting in a way that could be very favorable for crypto. The US Treasury just did something pretty unusual, a $13.5 billion debt buyback. Without going into the weeds, that's basically injecting liquidity into the system. The government buying back its own debt from the market means cash goes into the economy. It's a sign that maybe they're trying to ease up some pressures. And then we have the Federal Reserve, which for the last couple years had been the big bad wolf for markets by raising interest rates aggressively. Well, that story is changing now. The Fed already cut rates once recently, and they're widely expected to cut again in their upcoming December meeting on the 7th of December 2025. Odds are extremely high, around 90% according to market forecasts, that we'll see a 0.25% rate cut, bringing the benchmark rate down into the mid 3% range. If they follow through, it will signal that the pivot to an easier monetary policy is truly underway. And looking further out, the market is pricing in multiple rate cuts through 2026. So the trajectory is downward for rates, meaning cheaper borrowing costs over time. Now, if you've been in crypto for a cycle or two, you know that easy money and crypto bull runs often go hand in hand. When money is cheap and plentiful, investors are more willing to pour cash into riskier assets in search of returns. We experienced the opposite when the Fed was hiking rates. Liquidity dried up and crypto had a brutal bear market. Now, with rates heading down and even the Fed stopping their quantitative tightening, they ended it on December 1st, meaning they're not shrinking their balance sheet anymore. Plus, things like the Treasury's general account being drawn down and a lot of cash being freed up from other corners, like the reverse repo market dipping low. It all adds up to more liquidity sloshing around. This is the most positive liquidity backdrop we've seen since maybe early 2022. So think of it this way: the wind that was once in our face is starting to blow at our back. It doesn't guarantee the boat Bitcoin will move, but it sure makes it easier. All right, that's a lot of macro talk. Let's bring it back to our original question and tie everything together. Why is Bitcoin's supply on exchanges so low, and why should we care? I see a few big reasons for the exodus of Bitcoin from exchanges. First, trust, or the lack thereof, in exchanges. After the saga of FTX in late 2022 and various other exchange hiccups and scares, a huge number of people have decided, nope, not leaving my coins there. We learned the hard way that even big name exchanges can go belly up or freeze customer assets. So nowadays, if someone buys Bitcoin on an exchange, there's a good chance they're withdrawing it to their own wallet pretty quickly. Not your keys, not your coins, as the saying goes. I do this myself religiously now. If I'm not actively trading a coin, I won't leave it on an exchange longer than I have to. One of the best ways to self-custody securely is using a hardware wallet. I personally use a ledger device to store most of my crypto safely offline. It's like storing your gold in a safe instead of at the jewelry store. And if you decide to get a hardware wallet, which I highly recommend for anyone serious about crypto, make sure you purchase it directly from the manufacturer's official site. There have been cases of scammers selling tampered devices on third-party websites, so you want to avoid that risk completely. Actually, on my website, link in the description, I have a direct link to Ledger. That's an affiliate link, meaning if you buy through it, it supports the channel, but it doesn't cost you anything extra. Just being fully transparent there. Regardless of how you get one, the peace of mind a hardware wallet gives you is huge. It's basically your seatbelt in the wild ride of crypto. You hope you never need it to save you from a crash, but you're sure glad to have it just in case. Second reason, long-term conviction and accumulation. A lot of Bitcoin holders are in it for the long haul. When they believe Bitcoin is going much higher in the future, they take it off exchanges and put it in cold storage or custodial vaults because they have no intention of selling anytime soon. Think of big players like Michael Saylor's MicroStrategy. They buy thousands of BTC and stash it away like digital gold in a vault. Also consider the new Bitcoin ETFs and other institutional funds that require holding the actual Bitcoin in custody. Those guys aren't day trading, they're locking it up to back investment products or to hodl for the long term. So some of the supply leaving exchanges is literally being put into vaults to back ETF shares or being tucked into the wallets of long-term believers. These coins might not see the light of day or the open market for years, if ever. Third, strategic flexibility and risk management. This one might sound counterintuitive, but hear me out. Some traders and investors actually keep coins off exchanges until the moment they want to trade. Why? Because it removes the temptation to do something rash and also protects them from someone else messing with their funds. They'll hold their Bitcoin in their own wallet and only move a portion to an exchange to execute a trade when they feel the time is right. The rest stays offline, safe and sound. And speaking of risk management, I want to share a personal strategy here. I always maintain access to multiple exchanges, kind of like having multiple bank accounts or multiple escape routes in an emergency. If 2022 taught us anything, it's that even top exchanges can suddenly halt withdrawals or face downtime. And if that happens during a volatile moment, you do not want all your trading ability trapped in that one exchange. So I have, let's call it a plan A, plan B, plan C approach. I'm signed up and verified on a number of exchanges. For example, I'm active on platforms like Blowfin and Bitget, among others. So if one goes down or has issues, I can quickly switch to another to manage my trades or access my funds. By the way, on my website, linked below, I list all the exchanges I use regularly along with affiliate links for them. Using those links is a great way to support the channel if you happen to need to sign up for one. I get a small commission, which helps me keep doing these deep dives, but it costs you nothing extra. And I always disclose that so you know what's what. The bottom line here is never put all your eggs in one basket, whether that's exchanges, wallets, or even coins. Diversify where you hold and where you trade. It has saved my behind a couple of times when one exchange had a meltdown and I could still act on another. And speaking of risk, let me just put a quick reminder here because I know we're covering a lot of ground and I don't want anyone to get the wrong idea. This might shock you, but I'm not a financial advisor and nothing in this video is financial advice. Cryptocurrencies are highly volatile and you could lose all the money you invest. Always do your own research and consult a qualified professional. Your investments are entirely your responsibility, and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses. This video is for entertainment and educational purposes only. All right, disclaimer out of the way. Let's get back to it. So, where were we? Right. Bitcoin flying off exchanges and all the reasons behind it. We've covered the trust issues, the long-term holding trend, and the strategy of not keeping all funds on one platform. All of these have contributed to that 8-year low supply figure. It's a combination of people becoming more security conscious, more hodl minded, and more strategic about how they interact with exchanges. Now, during this investigation, I also stumbled onto something pretty cool that ties into this theme of taking control of your crypto journey. It's a project called Unity Nodes, and it's been getting some chatter lately, especially among those of us who follow World Mobile and the Minutes Network. The idea behind Unity Nodes is fascinating. It's about empowering regular folks to run network nodes using everyday devices like smartphones and earn rewards in crypto for doing it. So basically, Unity nodes provide software licenses. They're essentially NFTs in how they function, but let's call them licenses that allow you to spin up these mini nodes on mobile devices. Why is that interesting? Because if you can have thousands of people running nodes on phones globally, you decentralize the network a lot and potentially provide services in a community driven way. It's a novel approach to merging crypto incentives with real world network infrastructure. Now, I'll admit, when I first heard about it, I was a bit skeptical. It sounds a little too idealistic, right? But I also believe in experimenting and staying ahead of the curve with new tech. So I went ahead and got one of these Unity node licenses to try it out. That license actually came with the capacity to run up to 200 mini nodes. Am I running 200 smartphones right now, mining away? Ha ha ha. No, that would be overkill to start with. I'm starting small. I've set up about 10 phones as a test run. I want to see with my own eyes how this works, what the setup is like, and if the rewards are real and worthwhile. The cool thing is the rewards from Unity nodes are paid out in a mix of different cryptocurrencies, specifically Bitcoin, Ethereum, Cardano, ADA, and XRP. So if my 10 test nodes work and generate some yield, I'll be effectively earning a bit of all four of those coins. In a way, it's like diversifying your passive income in crypto, which I find really neat. It's similar to staking or mining rewards, but spanning multiple assets at once. Again, I can't stress this enough. I'm not saying Unity nodes are the next big thing or that you should jump into it. It's early, it's experimental, and like any project, it comes with risks and unknowns. I'm approaching it as a curiosity and a learning experience. If it succeeds, awesome. I'll scale up gradually and maybe turn on more of those licenses to increase the earnings. If it doesn't pan out, well, now we know and we learned something. Either way, I'll keep you posted on how it goes because I think there are a lot of innovative ideas in crypto that deserve a closer look, and this is one of them. If you're interested in the concept, definitely do your own research, read the Unity Nodes light paper, play around with their rewards calculator to see potential returns, and think about whether it's something that fits your risk tolerance. I've put a link in the description to those resources for Unity nodes if you're curious. But again, no pressure. It's not a sponsored thing or anything. I'm just sharing what I'm up to. Many of you who've been following the channel know I've mentioned Unity in the past, so consider this an update. I'm in the testing phase and cautiously optimistic, but we'll see how it goes over time. Now, beyond trying new projects, another big part of thriving in crypto is education. Understanding why things like exchange supply matter, knowing how to interpret on chain signals, and having a strategy for bull and bear markets. That stuff is priceless. That's actually why we started our own crypto education platform. Quick shout out. If you want to really level up your crypto game, check out Cheeky Crypto School at cheekyschool.com. We have courses on trading strategies, portfolio construction, risk management, basically all the things that help you make informed decisions rather than just guessing or following hype. And because you're watching this video, you can use the discount code YT50OFF to get 50% off any course on the site. There's a link in the description for that as well. We've gotten a ton of positive feedback from students who feel way more confident managing their crypto after taking the courses. So if you're looking to sharpen your skills and knowledge, it's worth a look. Also, if you're not already, join our free Discord community, link down below. It's completely free and it's one of the best places to be if you want to learn, ask questions, share insights, or just hang out with like minded crypto enthusiasts. I'm in there regularly, and so are a lot of experienced folks who are happy to help newcomers or debate the latest news, like this whole Bitcoin exchange supply situation. Crypto can feel like a lonely journey if you don't have a community, so we got you covered there. Okay, let's bring it all home now. Bitcoin's exchange supply hitting an 8-year low is a big deal in my book. It tells a story of increased self custody, of strong hands accumulating, of a market that's quietly bullish. It's like all the smart money and long term believers are battening down the hatches, pulling up the drawbridge, and getting ready for something. Maybe it's the anticipated Bitcoin ETF driven surge. Maybe it's just the next phase of the cycle. Maybe it's something we don't even see yet. But the point is, they're preparing, and I want to prepare along with them. The last time exchange supplies were this low, Bitcoin went on an absolute tear in the subsequent years. Granted, there were wild swings in between. Now, here we are again, potentially on the cusp of another major shift. I've positioned myself accordingly, keeping my assets secure, staying informed, and diversifying my strategies from multiple exchanges to experimental nodes. And I'm feeling cautiously optimistic about where this could go. Remember, though, cautious optimism means I'm hopeful but also prepared for any outcome. Crypto will always throw curveballs. That's its nature. Could Bitcoin dip again before the big run up? Absolutely. It's done that plenty of times. But data like this exchange balance metric gives me confidence that the foundation is strong. The weak hands seem to be out or sidelined, and the believers are in control of a large chunk of the supply. So don't be surprised if one of these days we wake up and Bitcoin is making a move that catches everyone off guard, except maybe those who've been watching the on-chain signals. At the end of the day, I'm not here to predict exact prices or timelines. I'm here to share what I'm seeing and doing so you can make better decisions for yourself. And what I'm seeing is a crypto market that is tightening up supply wise at the same time that demand drivers are quietly increasing from retail, from institutions, maybe from global events too. That's a recipe that in the past has led to some explosive outcomes. I'm excited, I'm prepared, and I hope you found this insight useful so you can be prepared too. One more thing, if you found value in this deep dive, do me a favor, hit that subscribe button. It really helps the channel out and ensures you won't miss future updates where we uncover what's really going on in the crypto world. Thanks for watching, stay safe, and I'll catch you in the next one.